Welcome back to Intermediate Accounting and a brief video providing an introduction to the accounting for leases. A lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use a specific property. And that property is owned by the lessor. So it is the lessor transferring the property to the lessee for the right to use it for a period of time. And leasing is the reason that we need to study this is leasing is really, really popular, particularly in information technology equipment. Think about computers, internet, wires, transportation, construction, and agriculture. The next couple slides show specific statements taken exactly from the footnotes to financial statements of various companies and allow you to see just how popular leasing is. We can see McDonald's, how many of their restaurants are leased, as well as Starbucks and TXU Energy Holdings, how much of its facilities and equipment it actually leases rather than owns. There are several advantages to leasing, and let's write out each one of them. Some of the reasons why you might choose to lease a car. Let's say right after you finish school, you start a job, you need your car to commute. What are some reasons why you might choose to lease rather than buy? Well, one of them is possibly the lease contract offers 100% financing. In other words, no money down. And when you first graduate school, you probably don't have a whole lot of extra cash to put money down to buy a brand new equipment or car. Another reason why you might want to choose to lease is protection against obsolescence, or in other words, in 2 or 3 years, you're done and you can just go into another lease to have another new car. Protection against obsolescence. Now, with a car, it's more of just not wanting to have an older vehicle, but think about technology, computers, not wanting to put all that money in, knowing that that computer can be obsolete or much lower in value in 2 years' time. Another option is flexibility. This might not be the case for you if you lease a car. The lessor is going to settle the terms, but and oftentimes in many contracts between a lessor and a lessee, it's a negotiated contract, and the lessor can tailor the terms to what the lessee might want. Last item would apply if you don't have the cash to buy a car and you went to a bank to get the cash to buy a car, you're going to pay a whole lot more in financing charges than you would if you were to enter into a lease agreement. So the fourth advantage is less costly financing. That was from the lessee's perspective. What about from the lessor's perspective, the organization, the entity that has the equipment or building and is willing to lease it out? Typically, this is going to provide profitable interest margins or profitable margins. That's why the companies are doing right, to earn a return. And it can also provide tax benefits. To the lessor. A lease conveys the use of an asset from one party, the lessor, to another, the lessee, without actually transferring ownership, which begs the question, should leases be capitalized? And what do we mean by capitalizing an asset? And we've been using that term over and over since Intermediate 1. To capitalize an asset, what does that mean? It means to record that asset on the books. Think about the difference. When you incur a cost this period, that cost can either be capitalized, reported as an asset, and if it's not capitalized, it has to be expensed. So would you rather that cost show up as an asset to bring you future benefits, or would you rather have it show up as a decrease to net income? Clearly, it's more beneficial to capitalize an asset than to have an expense immediately. But what about leasing? If you lease a car, should that be reported as an asset on your personal balance sheet? We know that you don't own it, but what about the right to use that car? Well, the accounting standards have recently changed for leasing, And under the current accounting standards, companies classify lease arrangements as either finance or operating, but in either case, companies capitalize all leased assets and liabilities. Well, we capitalize the asset and we record the liability on the books. The asset and the liability recorded initially, so when the company first enters into the lease agreement, the amount of the asset and liability is the exact same, is the same for operating and finance leases. But the amortization of that asset, if you think about equipment, we would call it depreciation of that asset. And the reduction in the liability as lease payments are made over time, they will differ. So we have the same starting point with the asset and the liability, but the expense recorded each period and the amount of the lease amortization. Instead of depreciation, we call it lease amortization. Recorded each period, they depend on whether the lease is operating or finance. So they will differ depending on whether it's an operating lease or a finance lease. The blank over the entire lease period is the same. The total amounts, the total lease expense, and the total amortization over the entire lease period is the same. Think about depreciation. If you use two different methods, whether you use straight line or the declining balance method, each period your depreciation expense is going to differ, but over the total amount of depreciation over the time is exactly the same. It's just an allocation of that cost over time. From the lessee's perspective, the lessee should classify a lease based on whether the arrangement is effectively a purchase of the underlying asset. So the question is, when you are borrowing it, does it look very, very similar to a financed purchase? Think about if you're not leasing a car, another alternative if you don't have cash is to go to the dealer and say, I'd like to borrow the money and finance the car. So does the lease look more similar to that? Or does the lease just look like a regular 2-year, make fixed payments, and at the end of the 2-year, return the car and have nothing, a traditional lease? If the lease transfers control or ownership of the underlying asset to the lessee, then the lease is classified as a finance lease. The lessee takes ownership or consumes a substantial portion of the underlying asset over the lease term in a finance lease. All leases that do not meet any of the lease finance tests. We're going to cover these tests over the next few slides. So if any of these 5 tests are not met, then it's not a financing lease. Then it's considered an operating lease. Just a couple of bullets here. The finance lease, it must be non-cancelable. Neither party can just simply terminate it when they feel like it. It has to be, for the contracted period, and it must meet at least one of 5 tests, which we see here. The transfer of ownership test, purchase option test, lease term test, present value test, and alternative use test. Let's go through each one of these items in these next few slides. The transfer of ownership test. If the lease, you guessed it, transfers ownership of the asset to the lessee, then it's a finance lease. Makes sense? If you're transferring ownership, then it looks just like a purchase. Test number 2, purchase option test. The lease purchase option allows the lessee to buy the property for a price that is significantly lower than the underlying asset's expected fair value at the date that the option becomes exercisable. This is typically called the bargain purchase option. And what it means in plain English is if the lessee has the option, the ability to buy the asset, let's say a car at the end of the lease term at a really, really low amount, and we can expect that the lessee is going to buy it, then that would make this whole contract look more like a financed buy or a finance lease rather than an operating lease. Next, we have the lease term test. If the lease term is a big portion of that leased asset, So if you have the right to use this for almost the entire time of that underlying item being leased, then it looks much more like a buy. And so what is that really long time? GAAP says 75% or greater. And let's say not just 75%, but about 75%. It's not a hard and fast rule. If the lease term is about 75% or more, we call this the 75% test. The lease term is generally considered to be the fixed non-cancelable term of the lease, and a bargain renewal option can extend this period. So what do we mean by bargain renewal option? At the end of the period, the lessee has the option to extend the lease at a really low amount and is expected to do it. Then if we expect the lessee to take advantage of a renewal, that is accounted for in the lease term test. We assume they're going to take that extra time. At the commencement or the beginning of the lease period, the difference between the new renewal rental and the expected fair rental must be great enough to make the exercise of the option to renew reasonably certain. Another test is the present value test. If the present value of all lease payments, almost the entire amount of the value of that asset, then that looks more like a finance purchase than simply just a regular operating lease. So what does GAAP have to say specifically? If the present value of all lease payments is reasonably close to the fair value of the asset, and reasonably close is defined as about 90% or more, then the lease is classified as a finance lease. What do we include in those lease payments when we're doing the 90% test? We look at any fixed payments, perhaps monthly payments, variable payments that might be a lessee of a building might have to pay an additional amount to the lessor based on revenues that are generated within the store in the building that's being leased. Residual value guarantees says that in the lease contract, the lessor might require the borrower, the lessee, to guarantee that when they return that asset, it's going to be worth a certain amount. And if not, that lessee has to make a cash payment. Also, bargain purchase options expected to be taken by the lessee, which we talked about. Using the present value test, the lessee needs to take the present value of those future cash flows, the lease payments. What discount rate should the lessee use? The lessee should compute the present value of the lease payments using the implicit interest rate. And what is the implicit interest rate? This is the rate at the beginning of the lease, which causes the total present value of the lease payments and any unguaranteed residual value to be equal to the fair value of the leased asset. And if the company cannot determine the implicit interest rate, then the lessee uses its incremental borrowing rate. What's an incremental borrowing rate? If the company didn't have this lease, then what would happen? It would have to go to the bank and borrow more cash. What would the lessee's expected estimated interest rate be if it had to borrow some more money? The fifth test is called the alternative use test. If at the end of the lease term, the lessor does not have, as you would expect, an alternative use for that asset, then the lessee classifies it as a finance lease. I can't do anything else with it. You pretty much purchased it. And finally, just an example, Home Depot leases Dell PCs for 2 years at a rental of $100 per month per computer, and subsequently can lease them for $10 per month for another 2 years. The lease clearly offers a bargain renewal option, so what would the lease term be considered here? In this case, would you expect this Home Depot to have a 2-year lease or expect them to use their renewal for an additional? Would it be 2 years or 4 years? Well, of course, it would be a 4 years. We can expect them to extend. $10 looks like it's a bargain to them. This concludes our introduction to accounting for leases. Over the course of the next few classes, as we finish the semester, we're going to be looking at some examples of the calculations and the journal entries for operating leases and finance leases. But as we prepare for class on Monday, we're going to look at just simply the conceptual differences between the finance leases and operating leases.